Ladies and gentlemen, good day and welcome to the GATI Limited Q2 FY23 earnings conference call hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikram Suryavanshi from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Renju. Good afternoon, everyone. On behalf of PhillipCapital, I welcome you all to Q2 FY23 earnings conference call of GATI Limited. We are pleased to have with us management team represented by Mr. Firoz Shah Sarkari, Phil, Chief Executive Officer, and Mr. Anish Mathew, Chief Financial Officer for GATI Limited. We'll have opening comments from the management followed by the question and answer session. Thank you, and over to you, Phil, sir.
Thank you, Vikram. Good afternoon and a very warm welcome to everyone on our Q2 FY23 earnings conference call. We have uploaded the results, press release and presentation on the stock exchanges and company's website. I hope everyone has had an opportunity to go through the same. Along with me, I have Mr. Anish Mathew, our Chief Financial Officer for GATI Limited, and our investor relations team. I will start by sharing the industry and business overview, and then we'll hand over the call to Mr. Anish Mathew to discuss the financial performance for the quarter. Strong demand supported the second quarter of fiscal year 2023, driven by growth in the key industrial sectors and led by an uptick in consumption in both urban and rural India. The e-way bills generation recorded an all-time high of over 84 million in September 2022, signaling a strong boost to economic activity on the back of a festive season. With government initiatives such as National Logistics Policy and PM Gati Shakti, we believe that the formalization of the logistics industry is underway, and there is a huge opportunity for organized players as the industry will see an accelerated shift from the unorganized sector to the organized sector. The National Logistics Policy is expected to revolutionize the sector, enabling supply chain management. The introduction of the National Logistics Policy is aimed at promoting seamless movement of goods, overcoming transport-related challenges, encouraging digitization, along with the significant reduction in time and cost. NLP, the National Logistics Policy, targets to reduce the logistics cost from a current 13 to 14% of GDP to single digits. This augurs well for the road logistics sector, as it shall reduce the overdependence on road through better integration of different modes of transport and in turn improve demand identification, thereby enabling better availability of trucks. GATI as a company firmly believes and supports the government's vision of $5 trillion economy and is poised well to play its part in helping achieve the goal. I would like to highlight here that GATI is exclusively partnered with the SME Chamber of India as their preferred logistics knowledge partner. Amidst the odds faced by the economy due to higher crude prices, rise in commodity prices, and overall inflation, GATI Limited from its express business has delivered a solid improvement in EBITDA for H1 FY23, showcasing a significant growth of 215% on a year-on-year basis. the performance is in line with our expectations and stated strategy. We would also like to highlight that our rebranding strategy of GATI Air is bearing fruits, with the segment growing at the fastest pace and achieving its highest ever quarterly revenue of 21 crores after several years. Our pillars for delivering performance remain consistent with a strong focus on customer delight. With our established principles of digitization, sales acceleration, infrastructure development, and operations, we have been able to deliver gross margin expansion and are confident of increasing the same going ahead. On the digitization front, the seamless movement of cargo has been made possible by our proprietary software GEM, which also has route optimization and faster turnaround capability. With that said, we are concentrating on improving our front and back-end digital processes to deliver increased efficiencies with our advanced modules. With sales acceleration, we continue to prioritize our MSME and retail business while aiming to increase the wallet share of our key and strategic accounts to help our profitability. We are committed to strengthening our presence by expanding our services deeper into the key growing markets and to cater to the growing demands of retail and SME. Regarding infrastructure amplification and our mega hubs, we have witnessed steady increase in the ability to handle high volumes post the commissioning of our mega hub in Farrukhnagar. Our mega hub in Mumbai has just about started today, and Bangalore should be operational in this coming year. Over and above the planned expansion across the country with our mega hubs, we also added 2 new distribution hubs at Nagpur and Guwahati in the last month itself. We anticipate that these hubs will add up to volumes for the coming quarter. Lastly, we remain aligned with our vision to maximize value creation for every stratum of society. We have also been focusing on few other ongoing initiatives like pilot run for pickup and last mile delivery using electric vehicles, ease of doing business with GATI for customers from booking till delivery, and embarked upon CSR activities for our contribution towards the society. With this, I would like to hand over the call to Mr. Anish Mathew, our CFO, for financial and operational highlights for Q2 FY23. Over to you, Anish.
Thank you, Phil. Good afternoon, everyone, and a very warm welcome to our Q2 FY 2023 earnings call. I will now take you through the highlights of financial results for the second quarter of FY 2023. For Q2 FY23, consolidated revenue from operations stood at rupees 435 crores as compared to rupees 399 crores for Q2 FY 2022, indicating a growth of 9% on year-on-year basis. EBITDA for the same period stood at rupees 28 crores as compared to rupees 18 crores, registering a growth of 53.4%. Pre-exceptional PBT stood at rupees 7 crores for Q2 FY23 as compared to 6 crores for Q2 FY22, registering a growth of 11.2% on year-on-year basis. For the half year ended September 2022, consolidated revenue from operations stood at rupees 866 crores, registering a growth of 25.5%. EBITDA stood at 52 crores, registering a growth of 175.3% as compared to H1 FY22. Pre-exceptional PBT stood at rupees 11 crores as compared to a loss of rupees 6 crores in H1 FY22. Our express business has been delivering strong performance, with revenue from operations increasing from rupees 334 crores to rupees 370 crores in Q2 FY 2023, up by 10.8% on a year-on-year basis. For Q2 FY23, Tonnage witnessed an increase of 8% year-on-year and stood at 283,160 metric ton. Also, during the quarter, we have achieved a milestone of handling 1 lakh tons in a single month. EBITDA for Q2 FY23 stood at rupees 27 crores as compared to rupees 17 crores for Q2 FY22, signifying a growth of 57.8% on year-on-year basis. Pre-exceptional PBT stood at rupees 6 crores for Q2 FY23 as compared to rupees 5 crores for Q2 FY22, registering a growth of 11.9%. For the half year ending September 2022, revenue from operation for express business stood at rupees 735 crores, registering a growth of 28.5%. And EBITDA stood at rupees 52 crores, delivering a staggering growth of 214.8% as compared to H1 FY22. Tonnage handled during H1 FY23 stood at 562,000 metric ton, thus registering a growth of 27.7% as compared to H1 FY22. Pre-exceptional PBT stood at rupees 11 crores as compared to a loss of rupees 7 crores in H1 FY22. We will consistently providing other key comparative financial performance indicators in our investor presentation. One can refer that for more details. With this, I would like to open the floor for question and answers.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Amit Dixit from ICICI Securities. Please go ahead.
Thanks for the opportunity and good evening, everyone. I have 3 quick questions. The first one is it possible to quantify the EBITDA of Surface Express and Air Express businesses separately without taking other income into consideration?
Mr. Phil, please go ahead with the and answer the question. Mr. Amit, can you please repeat the question once again?
Yeah, sure. I have 3 questions. The first one is it possible to quantify the EBITDA from Surface Express and Air Express businesses separately without taking other income into consideration? That is the first question I have.
Mr. Phil?
Can you hear me? Hello?
Yes, Mr. Phil. Just give me a moment. Mr. Amit, please go ahead with the...
I heard the question. I can answer it. So like I was saying that we don't measure our EBITDA margin separately for our air and surface products because we have a combined operations on the ground and we only measure our gross margins on the products separately, and our gross margins on both these products are very similar.
Okay, fair enough. The second question is in H1 FY23, receivable has gone up by 734 million rupees, while payables have also gone up by 221 million. Is it possible to give more color on these? More specifically, can we expect certain unlocking of receivable as the year goes by?
Anish, you want to take this question?
Yeah, so receivable is, I think in Q4 and Q1 earnings, we mentioned that we would be kind of doing an unlocking of the working capital from out of the accounts receivable. So we kind of have already initiated our action plans around unlocking. and it starts kind of bearing the results. And it might take maybe one more quarter or 1.5 quarters to kind of get full realization.
Okay, so what kind of receivable number can we expect by end of FY23?
Well, we are looking at kind of close to 10 to 12 days of receivable reduction, DSO reduction. In quantum, that would be anywhere between 40 to 60 crore rupees of reduction.
Cool. The third and the last question is, other income contains, certain write back of liabilities and reversal of provisions. First of all, can you throw some light on both these items? And is there some more scope of, getting these write back of liabilities and provision reversal in subsequent quarters?
So predominantly the other income are driven actually by two line items. One is the security deposits which we had, which is more than 3 years, and as for the accounting policy, all the inactive vendors security deposit which is lying there for more than 3 years, we would do a write-off as per the accounting policy. That's the one factor actually which has contributed to other income. The second one is related to the old accounts payable, again as inactive for more than 3 years, which we have taken a write back. So we have kind of done almost all the write back in the P&L account. Depending upon the age of the payables, there might be some more which would be coming in the subsequent quarters. But we can't at this point in time quantify that.
Okay, fair enough. Thanks a lot and all the best.
Thank you. Next question comes from the line of Dhaval Shah from Girik Capital. Please go ahead.
Hello. Yeah, hello, Mr. Sarkari. Very encouraging to see the growth in the Air Express division. So, hi, am I audible? Hello. Hello.
Please get nearer to the speaker.
Okay, fine. Am I audible now? Fine.
Yeah, much better.
Oh, thank you. Yeah. So a couple of questions from my side. So first being, the EVA bill generation in the second quarter compared to the first quarter was around higher by 6.5%, while the tonnage handled by GATI, quarter on quarter is higher by 1.5%. So is it a right way to to compare some comments from your side? That's my first question.
So, as you know, I have been saying this for now a few months that at GATI we are developing our infrastructure so that we can increase our top line and not reduce the serviceability of that increased volume. In the meantime, what we have done and is very evident from the numbers is that we have been concentrating on increasing our profitability. And therefore, although the growth quarter to quarter has been only 10%, you can see that the EBITDA is up by 53%, right?
Correct.
And while as our infrastructure grows, we will then make sure that corresponding volume also grows, because in the current infrastructure, it was very difficult for us to manage increased tonnage. Having said that, the operational efficiencies have kicked in and we have even grown the tonnage quarter to quarter, as you can see, but not in the same line as we would have liked to grow.
So you were constrained by capacity. Is it the right conclusion?
Yes, in a way.
In a way, okay. And this new hub which came up in this quarter, so has it added materially or it came towards the end of the quarter?
It just came in last month, both of them.
Both of them. Okay. Got it, sir.
And Guwahati.
Okay. And has Mumbai got delayed? It was supposed to come.
Yes, Mumbai had got delayed, but as I said on my call today, we have started moving into the Mumbai hub as of today itself. So we will see Mumbai full-fledged from December.
Got it. So the second question is, I was looking at a couple of advertisements of GATI KWE, and where the company is advertised for the products like some spices and cashew nuts and agarbatti. Now my question is that GATI KW being an express logistic company, does the value of these products fit into the express logistic basket? Is it affordable for the customer to transport via express logistics? Yeah.
So we have three segments of business. We have what I call large accounts, MSME and retail. And this, what you just spoke about, is specific to the retail market. These are clusters where we moved the businesses from only on a B2B basis, right? So you're moving cashew nuts, you're moving coconuts, you're moving whatever you just said from a retail market. So these are pretty seasonal, and they are not being given the credit that we give the normal customers. But they do give us a better yield. And they do use express because they have to make sure that their products reach on time for a certain festival or for a certain reason. So yes, they do utilize the express business, but in our retail segment.
Okay. So then this would, because generally these products are for a LTL or generally an LTL kind of business model, and not express exclusively. So here the rates what they are the service what they are taking is the express service in terms of the turnaround time for the product to reach the destination.
Yes.
Okay. Got it. And so last question is, so now all cargo will convert the warrant and infuse money in GATI. So if you could, lay down the, use of the funds and, the CapEx requirement for GATI for FY23 and 24, and also more on the, the upgrading the IT infrastructure, and how are we building up our capabilities compared to the peers? Yeah.
So if you have been seeing over the last 2-3 years, after All Cargo has bought out GATI, one of the important things that we have been doing is repaying the debt or the loans that were there in GATI earlier, which has come down substantially. One of the use for the funds that will come in moving forward also will be that we have a working capital debt right now. We'd rather close that and use our own funds as we start generating cash in the near future. With regard to our new hubs, I have said that these are all asset light. They are all on rental basis, and the capex of a new hub approximately on 100,000 square feet is ranging anywhere between 5 to 6 crores, which is not a very large capex spend. I hope I've answered your question.
Thank you. Mr. Dawal, we may request that you return to the question queue for follow-up questions. The next question comes from the line of Alok Deora from Motilal Oswal. Please go ahead.
Good evening, sir. And just had a couple of questions. So first wanted to understand on the demand trend, how has it been, say, for the festive season for us and also in October? And do we see the same revenue run rate continuing in the second half of this year? Because we have been getting some signals of some slowdown in selected pockets. So just your thoughts on the express B2B side.
So in spite of the fuel prices being held and also the inflation, as you see, we saw a good demand for the festive season, specifically in the automotive sector and the consumer durable sector. And we did the highest ever tonnage in the month of September, which was even more than 100,000 tons, and that is with the same capacity that we have. October, having so many festivals, had lesser working days, but if you see the revenue per working day, it has remained the same. I'm not seeing for the express industry a real slowdown. In fact, we see the trend continuing for the month of November too.
Sure. And also, sir, the margin guidance which you had given of around reaching 10% by end of this year, so that we are on track with that, or any changes there?
So I had said that we will end this year at 9%, and we continue to say that we are on track. We have seen a lot of operational efficiency being brought in and our gross margin increasing every month, and we are very sure that by last month of this year we will touch 9%.
Sure. Just a last question. So since you highlighted about the strong growth in the air express segment, so how are we seeing this segment? Like, say, if we see a couple of years down the line, how big this segment could be for us in the overall scheme of things? Would it be in the current range in terms of percentage contribution to total revenues, or it could be higher than that?
So if you look at the Indian logistics industry, specifically to the express business, it is a 90-10, 90% surface and 10% air. And our air share is just about a little above 5% just now. We definitely, our first benchmark is to get the air business to 10% of our total business. And then, of course, if we have to be better than market, then a good aspirational figure should be about 12 to 15%.
And we will be making similar margins in air as well.
On the gross margin, yes.
Okay, sir. Right. That's all from my side. And thank you and all the best, sir.
Thank you. Next question comes from the line of Gautam Gosar from Perpetuity Ventures. Please go ahead.
Yeah. I have one clarification. So the guidance which you've given for the EBITDA margins of 9% and going forward, taking it to 12% to 15%. So does that include other income or without other income, the margin guidance?
So it depends on what you call other income. For me, when I generate cash in the business and get interest on that cash, it is other income. But if it is extraordinary income, no, the answer is no.
Okay. So basically the interest on fixed deposits will be included in the margin guidance which you have given, right?
Yes.
Okay. Thank you.
Thank you. Next question comes from the line of Ria from Equitas Investment. Please go ahead.
Hello. Thank you for giving me this opportunity. So I have a couple of questions. So for our Surface Express business, for tonnage-wise, we had just on a QOQ basis, we just did 1.5% growth. So what was the reason for that? And as per the earlier participant, since our capacity was constrained, so for the coming quarters, could you guide us the volume and how it will pan out?
So if you really look at my first quarter results, our growth in the first quarter was higher than what the general expectation in a first quarter of a financial year is, and this was because there were certain competitive elements for which we had got more volume. And therefore, growing our second quarter business looks a small growth, 1.5%, but it is a large business. It is just because in the first quarter we got that additional growth due to competitive, disruption. So I hope I've answered your question. Moving forward, we are very buoyant that we have now got our Bombay hub up and running. Like I said, we have just started the shifting from today, tomorrow, and we will have at least 2 full months of the new Bombay hub, and therefore our west loads must increase just the way our north loads increased when we opened up Farukh Nagar. Similarly, our central and northeast have just been a month old, and we should see volumes increase in those zones too. So yes, growth will continue.
Okay, and as far as demand is concerned, are you seeing, because major, like the value additive higher yield is given by the smaller or the MSME players, are we seeing a shift or drift from there, like as compared to the total percentage derived?
Well, the endeavor for us is always to grow the MSME and retail faster than our key and large business. It's a big challenge because as we grow the large business, each large business gives us much larger volume than what an MSME and a retail gives us. So if you see our growth in each segment, whether you call it MSME and retail put together or you call it large, has been very similar. So we have been growing both the businesses. That's why our percentage share has remained almost the same.
But going forward, what kind of percentage drift would you want to expect? Like, of course, you would want MSME to grow, but what kind of the, like, on ground, what is happening? Like, how is the demand from their side?
The demand from the MSME segment is definitely good and will only get better as we see more and more manufacturing happening in this country. I think the new logistics policy is going to enable more manufacturers to get the confidence to come in and manufacture, since the logistics cost is going to go down, and therefore the MSME sector will get more business. So MSME will be a growth engine for us.
Okay. And going forward, do we see any hike in realization?
Well,
Hello.
I have always said this, that in the Indian logistics industry, there is enough scope to reduce cost, right? We have to continuously optimize and reduce cost. Yes, we will very soon be announcing our annual hike. But the name of the game in logistics, especially in India, is cost optimization and bringing efficiency.
Okay. Any guidance you would want to give for the annual hike?
You'll soon get to know. We'll be announcing it in the papers itself.
Okay. Thank you so much. That's all from my end.
Thank you. Before we take the next question, a reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Pradyumna Chaudhary from JM Financial. Please go ahead.
Good evening, sir. So first question, I just wanted to understand, like, one of our direct competitors, which is listed, few months back it opened its Gurgaon hub and seems to be doing well. So from a competition perspective, how does it really affect us? Like, even that's a very big hub. And so does it really directly affect us? I just wanted to understand from a business perspective.
25,000 crores is the organized market size and an equal, if not more, unorganized market size. There is enough room for all the players to grow in this market. We have to convert the unorganized to organized, and that is the way all of us should be able to grow more than the market rate of growth.
Okay. And secondly, I was just looking at your Surface Express tonnage and revenue, Q1 and Q2. So there seems to be a slight decrease in realization, is my understanding, Q on Q. What would be the reason for the same?
So the slight increase or decrease happens depending on the lanes that the customer gives us. There will always be fluctuation of a percentage here or there depending on the lanes that the customer gives you during that particular period of time. Nothing alarming has changed either in the profile of business or in the revenue per piece.
Okay. And just one bookkeeping question. What's the gross margin in this quarter?
So the gross margin
for the GATI KWE.
Given in the, have we given the gross margin? 28.3%. 28.8%, sorry.
Okay, I'll join the queue back. Thank you.
Thank you. Next question comes from the line of Sagar Bhatia from Prabhudas Lilladher. Please go ahead.
Hi, sir. Congrats firstly on a good set of numbers. My question is a little more tilted towards the client mix, which you already mentioned before. I want to know, going forward in the next 2 quarters or even in the year, how does that mix look like for you? And second, which segment has contributed the most to your EBITDA expansion? Or was it just a function of increasing efficiency through whichever medium you have done?
I keep repeating the same answer over and over again, and I will do it once more for you. We clearly have a focus on MSME and retail. Okay? That does not mean we stop getting new business or better wallet share from the large customers. Basically, if you have to optimize cost, the one factor that you have to keep in mind is capacity utilization. And capacity utilization is a direct derivative of volume. So yes, the large volume does help us to reduce cost on our major cost, which is our network. So it's a balance between both yield and cost reduction, which has given us our gross margin.
Okay, thank you.
Thank you. Next question comes from the line of Saloni Himani from Mulukul Ventures PMS. Please go ahead.
Good evening, sir. So the rest of my questions have already been answered. I just have one remaining question. So we have been extending the timelines for hubs like Pune, Hyderabad, Cochin in our PPT in the last couple of quarters. So any reason for that?
So I had given timelines for Bombay and Bangalore. Yes, both of them have been extended. Bombay specifically by more than a couple of months. Basically, Bhiwandi is a challenging area, and we can't really have control over the construction, since these are all built to suit done by the investors and landlords. But happy to say that we have started shifting in today over there. Bangalore specifically is because of the rain. There has been some torrential rains, and therefore the ground the plinth which was supposed to come up much earlier took more time because of the monsoon. Having said that, we are always on the lookout if we find something which is suitable and can be taken up, like I would say, off the shelf, and that's what we did in Nagpur and Guwahati. We found good properties and we have just taken them, and they basically meet the requirements of our expanded infrastructure. So a combination of these will continue, but we are very optimistic that by March of 23, our first phase of infrastructure expansion should get done.
Okay. Sir, a follow-up on the hubs. So our competitors have also come up with new mega hubs, and from the looks of it, they look a lot more automated than the Faruk Nagar hub that we visited a couple of quarters back. So anything you want to highlight about the automation part, about are we going to automate the hubs going forward, and we are just focusing on building them right now?
Well, automation in a B2B business is very different than automation in a B2C business. In B2B business, when I talk about automation, it is basically dock levelers, and in our Faruk Nagar hub, I think we have more than 80 dock levelers, almost one on every dock. When we talk about automation, we talk about material handling equipment to ease the manual handling of the goods, and we also talk about loading, unloading through telescopic conveyors. So the first two, which is the dock levelers and the material handling equipment, we have, every time we open a new hub, we will have that already. The telescopic conveyors is something that we are looking at in Faruk Nagar just now, as we say, on a trial period. And if it really works, because our per docket load is 100 kgs in GATI on an average. So it has to work for such a big load, otherwise it doesn't make sense just for the sake of automation to do automation.
All right, sir. So just one more question on the 100,000 tons part that we achieved in this month. Are we expecting to continue with this trend going forward, sir?
Oh, absolutely. So we have done 564,000 tons in the last quarter, right? If you were to divide,
right.
Sorry, no, 564 in the last 6 months. 330, 370. 1 second, I'm a little confused. 280.
It was 280.
Yeah, 285,000 tons in the last quarter. So if you divide that by 3, it is already on an average more than 90,000 tons, right? So definitely we will be continuing this effort, and as we open new infrastructure, we will go and talk to our customers that we are ready for more business in that particular region.
Okay. Thank you, sir. So that's it tonight.
Thank you. Next question comes from the line of Bhavin Shah from Samiksha Capital. Please go ahead.
Yes. So, you've given very precise, targets for EBITDA margins for year end and in long term. So at what revenue level would you achieve that? That's my first question.
So there are two kinds of margins that we speak about, right? One is the contribution or gross margin, and the second is the EBITDA. Expansion of the gross margin and revenue increase Combination of these two will expand the EBITDA because we have now reached a stage in below gross margin costs where they'll be directly proportion to the revenue. They are not variable. So we can leverage that with the increased gross margin and revenues. When I talk about my 3,000 crore exit rate with a 12 to 15% EBITDA margin, that is basically the first target that we have set for GATI when I came into the organization. Our gross margins have increased far better than my personal expectation in a short period of time in GATI, and that kudos to the operations team that has worked well for us. So as we move forward, a combination of expansion of gross margins and revenue increase will get us the EBITDA margin.
Okay. Now, there are two observations which I want to, or 2 points I want to make, and then we will see how you relate to that versus your business. One is, what sort of premium are you getting for express versus normal LTL guys? And second is, how do you see your business getting impacted once DFR, the dedicated freight corridor is fully operational, which could shift some business to rail?
So in GATI, we don't do LTL business. We do only express logistics business. LTL business margins can differ dramatically within that business. But for us as express logistics, I think our yields are comparable to the yields of competition in the same express logistics business. With regard to freight corridors, we at GATI are very excited about both the freight corridors as well as the multimodal parks that are going to get opened, because if a railway siding is going to be extending into the multimodal park, then the entire cost of transportation becomes far lesser for us as an organization and more effective for the industry as a whole. So a combination of the freight corridors with the multimodal park would be very, very accretive for reducing the logistics cost in India.
Okay, thanks. And my question was, like, how much price premium you are able to get over the normal LTL, non-express LTL, because that is important, in terms of given the higher cost.
Well, like I said, when you go non-express, LTL is generic. LTL could be Bombay to Delhi in 15 days, Bombay to Delhi in 20 days, Bombay to Delhi in 8 days, right? It depends on what the customer wants, and therefore the price could vary anywhere between, let us say, 5 rupees and 7 rupees per kg. Whereas the yields for express logistics is on an average above 12 rupees.
Okay, thanks.
Thank you. Before we take the next question, a reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Rahul Picha from Multi-Act PMS. Please go ahead.
Yeah, thank you. Sir, I wanted to understand firstly that you have given a medium-term guidance on where you want to take the EBITDA margins of the business. But when I look at the depreciation cost and in context of the hubs that we intend to add over the medium term, that has been going up, and the way the accounting is, depreciation also accounts for the lease rentals that we pay on our long-term leases. So in that context, how do you expect the depreciation cost to increase over the medium term? And in context of that, where do you expect the PBT margins to be in 2 years' time?
Anish, would you like to answer that question?
Well, I think your question is directly related to the PBT margin. So I would put it this way. The depreciation accounting or the Ind AS accounting is getting reflected in the EBITDA, and equal amount is getting offset as a depreciation line. So net that, it's not going to be having a major impact actually on the PBT line. So you would be giving a credit to your EBITDA line on account of Ind AS, but you'll be debiting depreciation as well as interest charge, in the below EBITDA line. So net as the PBT line would more or less kind of remain the same.
Okay.
There will be marginal increase or decrease actually in the margin.
Okay. So basically, on an aggregate basis, you are saying that it will only be reallocation from other expenses to depreciation, but not an overall increase.
Yeah, at the PBT line, it would have been a very, very insignificant impact.
Okay. So your guidance of 12% EBITDA translates to what kind of a PBT margin?
Yeah. 12% will give a PBT margin of around 5%, 4 to 5%, 5 to 6%.
Okay. Okay, got it. Thank you.
Thank you. Next question comes from the line of Nidhi Babaria from Envision Capital. Please go ahead.
Yeah, hi sir. Thank you for taking my question. Sir, when we say that we have capacity constraint, is it like we have less number of trucks, or is it more to do with the efficiencies in the hub centers?
It is more to do with the space and the way some of our old hubs have been constructed. Nothing to do with transportation. Transportation capacities can be increased or reduced because we are an asset-light company. So even if I double my tonnage, I can manage the transportation today. It is the hub centers. For example, and I'm repeating something here, in North we had 3 separate hub centers earlier, and a single truck had to unload and load from 3 hub centers before it moved out of Delhi. There was tremendous inefficiency there, and each of these hub centers had hardly 5 docks each. So you can imagine turnaround time of a hub, right? Similarly, in Bombay, we had 2 separate hub centers, one in Panvel, one in Bhiwandi. So the trucks had to actually move from one hub center to another for both loading, unloading over there. These are inefficiencies that were built over the years, and once you kind of collapse this and make it one single large hub center with requisite docks, say around 80 per 100,000 square feet that you make, that is where the capacity becomes good enough for volumes to increase. I hope I've answered your question.
Yes, sir. And sir, when we say that we have a revenue target of 3,000 crores by FY26, this means that we need to grow by at least 18 to 19% CAGR. And in current quarter, we have grown roughly about 9% YOY. So what gives us the confidence that we will be able to grow more than 20% in coming quarters? Or what is the correct roadmap to the growth to achieve 3,000 crores?
First half over last first half, I have grown 30.6%.
Okay.
Right?
Yeah.
I think if I keep growing this way, I will hit my numbers easily.
Okay. And so when we say that our EBITDA margins are going to improve in context, in line with revenue growth and gross margin growth, what exactly is going to be there for us to expand our gross margins? Like, how are we planning to increase our gross margins?
So our gross margin expansion is a combination of reduction cost, and reduction cost comes out of capacity utilization of trucks as we move the trucks. Every 1% additional capacity beyond 85% gives you tremendous cost reduction in the trucking industry. The second is, of course, your yield. So as you increase your yield, that increases your gross margin. So combination of these two will expand the gross margin.
Okay. And sir, one last question. Any outlook on Guwahati and Nagpur center? Like, is there any way to quantify how these centers are going to contribute in our efficiencies on revenue side or on the gross margin side? Like any rough picture on these two centers?
So I can only tell you this much, that from an efficiency perspective, we see immediately an efficiency enhancement of 20 to 25% when we open up a new hub, right? Which means that we can do the same job with lesser number of people, and we can turn around more trucks in the same amount of time. Once that happens, service enhances and customers get more confidence, and therefore they start giving us those lanes also.
Okay. So, is there any way, where we can say that initially our turnaround time in those regions were 24 hours, and with these centers it will come down to, let's say, 18 hours or 20 hours, any those kind of numbers?
So a truck in Farukh Nagar turns around in 90 minutes it gets offloaded, and 90 minutes it gets loaded, which is basically, if you put them together, 3 hours. Before that, it was taking 8 to 12 hours.
Thank you. Ms. Babaria, we request that you return to the question queue for follow-up questions. The next question comes from the line of Ash Shah from Elara Capital. Please go ahead.
Hi, so can you hear me, sir?
Yes.
I have a couple of questions on the fuel station side. So could you just give me the timeline as to when will the fuel station be divested completely, and how many petrol pumps do we own currently right now?
So we have 3 fuel stations.
Okay.
If you can help me with timelines when we deal with the oil ministry, I would be very happy.
Okay. And also
please don't take it serious.
No. In the first quarter Concall, you had mentioned that there were certain assets that were held for sale, and we were in various stages. So, and we were going to receive some money in Q2. So, have we received any money from them, or could you just update on that?
Sure, Anish, could you take that one, please?
So, AHS, we have sold many properties, and the total amount of money realized on account of sale of asset held for sale for 6 months, that is September, is 67 crore rupees. So, okay. That's a significant amount of money which we have realized. And our AHS have come down from 134 crore rupees to 94 crore rupees. We have 12 to 13 properties which is yet to be sold, and we do have almost like a 20% visibility for those remaining assets, and we expect to get a good amount of realization as in the next 6 months.
Okay. So, and we are going to receive around 70 crores from All Cargo in the Q3, and we'll receive around, supposedly, if we say 70 odd crores from the asset sale, assuming. So, do we see that we will be like gross debt free or by FY23?
No, we won't be able to square up our debt by 23, because there are other commitments, capital commitment as well. And that's what we have been providing the guidance on. So I think most likely by FY24, 23-4, you would be nil debt.
Okay. Yeah, that's all from my side. Thank you so much.
Thank you. Next question comes from the line of Krupa Shankar NJ from Spark Capital Advisors. Please go ahead.
Hi, good evening, and thank you for the opportunity. I had just one question, broad question, Phil. While we have seen the growth of express industry post GST, and what you're also seeing is a lot of supply chain getting realigned, and emphasis placed on secondary distribution. Now, the extent of upbeat expectation on revenue growth over the next 3-4 years, being upwards of 20% for the industry. Are you seeing any specific end user sector which are adopting express logistics in a much faster way, or are you seeing any specific indicators on the underlying sectors? That's something which I wanted to pick your brain on. Hello?
Mr. Anish Matthew, we cannot hear you.
Oh, sorry. I was talking, not Anish. Can you hear me?
Yes, we can hear you now. Thank you.
Okay. So what I was saying is, traditionally, the industries that used to use express logistics was auto industry, specifically for the aftermarket business, which is the spare parts and components business. We used to also see pharmaceuticals using express logistics to reach their goods to their distributors and CNF agents. But there is a big change now happening with the advent of e-commerce. A lot of the consumer and brands are using e-commerce to using B2B express logistics to reach the warehouses of the e-commerce companies so that their goods can ultimately reach the retail customer. So there is a big growth, and as more and more of these so-called D2C brands come up, they have to use B2B players to move from their manufacturer to the warehouse before they can really send it out in the last mile. And that's a big segment that is coming up now for B2B express logistics.
Got it. And I know we have had this interaction in the past wherein you are seeing a lot of consolidation with respect to warehousing, and from what I can gather with respect to what you've just said on the retail industry. So it's more of, is it fair to say that the inventory is getting far more leaner, and or rather in the system, the extent of inventory kept by the company is coming off, and it's far more centralized, which is also one of the drivers. If that is the case, then is it fair to assume that it has played out to a certain degree in some of the sectors, and there are other sectors wherein it is likely to happen? Some thoughts on that front.
You're absolutely right. Post GST, inventory on wheels becomes extremely important. Pre-GST, there had to be stocking locations in every state. Now it is no longer required, and inventory on wheels becomes very important, and it has to be predictable inventory on wheels. And most of the customers do not want their distributors or their retailers to hold large inventory, right? So therefore, express logistics will play a very critical role for them.
Thank you for answering for that. I'll get back in the queue.
Thank you. Due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Okay, so thank you everyone for attending this call. If you have any more questions, you can either contact our SGA, who is our investor relations company, or Ankit, who heads our investor relations. Thank you very much.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.